Hello Invalid investors, thank you for joining me. Today I want to talk about Asana and why I believe that Asana is a compelling investment. We're going to talk about what Asana is, the things that I like, the things that I don't like about the company, and then we're going to talk about its valuation. If you haven't done so already, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why, with balanced arguments for the stocks I own. So you're welcome to do a totally free trial to see if it suits you. So let's get started. So Asana is a company that's kind of newish on the block, and I've kind of been following this company and I've kind of been a little bit bullish but didn't really put my money where my mouth was, and now I think that the time has come that I will do this and we'll see how that works out. Anyway, so Asana is a productivity tool. The way it positions itself is as a collaboration tool set. So if you've ever been in a large organization and you're kind of going through emails to figure out who does what and who's responsible for what and what's going on, and if you've ever done all that and it's kind of a silo kind of operation, you'll see that Asana kind of really solves a lot of problems in that space. So that's how it positions itself. Now, the company is very kind of buzzword heavy, but once you kind of cut it out, it actually has tangible numbers, which I think are somewhat attractive. So 59% of its revenues are customers that are on 5K or more annualized. So that's quite attractive, okay? But what I think is really compelling is that year over year, the number of customers on 5K or more is up 58% year over year. So I think that's quite attractive. And at the top layer, the customers that are on the threshold of 50K or above have actually grown 100% year over year. So I think that those metrics are kind of like, okay, that's kind of attractive. I think there's something that's kind of going on there. Also, the company just reported back in December that its revenue growth rate for Q3 was up 55% year over year. But then its guidance was down for 45% year over year for Q4. So here's the thing. So the first thing that I kind of got maybe it's not that kind of interesting is that there's this deceleration as the year progresses. So that was one thing that kind of kept on my mind, but I was willing to give the benefit of the doubt to that aspect because I know the companies often have this kind of sandbagging effect. But the thing that I was kind of like, oh man, I don't really want to be too involved here, is that operating margins are guided to be down 57% year over year, 57% in the best case. So in the best case for Q4, operating margins are going to be 57% negative. So for the company to grow by 45%, to be so negative, I mean, I was like, okay, yeah, this is not really for me. But then I've had some time to think about it, month of December has gone past, and I'm thinking to myself, okay, so non-GAAP gross profit margin is 88%. Now, I follow many companies in SaaS space. That's pretty hot, like 88% is pretty much it's very attractive. And so I kind of, okay, maybe they have a lot of wiggle room here. Maybe there's some operating leverage. So maybe they're doing this kind of land grab. And as customers start to stay on the platform and they don't have to build as much of a onboarding or customer experience, there may be some wiggle room there for them to balance out some of that profit margin versus revenue growth rate. So now I'm kind of giving it the benefit of the doubt on second thought. Another thing that I'm kind of interested here is that if the company is expected to grow, let's say round numbers, okay, so if it goes into next year growing at 35%, you're hitting about 297 million, just shy of 300 million in revenues. So that's for next year that finishes in January 2022. So at that point, if you take the number of shares outstanding in Q4 of 158 million, you're about 4.8 billion market cap. So you're paying about 16 times forward revenue for a company with very, very hot gross profit margins. So I think that there is something there. I think that paying 16 times forward multiple is not a punchy multiple if you consider what the rest is paid. So I just plucked out two of these numbers here. So if you look at Atlassian is obviously a crowd favorite and it trades as 28 times forward revenues. So that's kind of like punchy. A more realistic metric would be Slack. Slack is getting acquired at 21 times next year's revenues. That's what it would kind of do as a standalone business. So that's 21 times, and Asana is at 16. So I think that there is some kind of wiggle room there. And so I don't know, on balance, I think that if I look throughout the space, I don't know of many companies in the SaaS space that are growing at north of 30%, still being priced at below 20 times forward sales. So I think that, on balance, I think that, it's a kind of a mixed bag if you think about its profitability profile, but I think that it's not too expensive. I think that we'll see how it goes. And as always, this is stock that I may or may not own, and this is videos for educational purposes only. And one more thing, don't forget to check out our marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why, and you're welcome to do a totally free trial to see if it suits you. See you next time. Bye.